Welcome to Allan Reports TV. I'm your host, Allan Labucan from allanberryreports.com. Today we have a new installment of our week in review. Got a lot to talk about today. Before we get started, we always like to start out with our thank yous, and we use youtube.com and ustream.tv to produce and broadcast these shows so you can watch them at your convenience. We've actually turned sort of to our youtube.com as the primary website we use. They were kind enough to recently include us as one of their broadcasters that's able to do more than 10-minute or 15-minute shows, and so we thank them for putting us on that list. And now we don't have to be as quite concerned with our timing there. So again, thanks a lot to the folks over at YouTube. And if you're watching the show on our website, if you look to the left and right of me, you'll notice that we have some banners. Those banner sponsors are really important in us being able to bring these shows to you. And if you want to do some homework on those companies, just click on their banners on our website. It'll take you to their website where you can do a bunch of homework and check out what those companies have on the go. And of course, you, the viewers, if you didn't show up, we wouldn't have a reason to do the show. So thank you very much for tuning in and allowing us to have an audience to do these shows where we talk about commodities, resource stocks, the stock market, politics. We get into a lot on the show, so thanks a lot. So now we'll get on to today's program. Before I get started, just wanted to do a little bit of housekeeping. We have, if you're coming to this show, what we do is each show on any particular date, the current show is uploaded into our video player on our website. It's also can be found on our YouTube channel. So if you're coming here to watch one of our previous shows from earlier in the week, the best thing to do is to look to the top of me there. You'll see a YouTube link, and then you can find all of our past shows on there. So that's a really good way to sort of navigate around what our past shows. And if you want to find out little overview of each show, if you look below me on the website video player, you'll notice that we have a text field there. In the text field, we do a little overview of which companies were talked about, and then we link them up to our YouTube channel as well, so you can find those shows. Since last week when we did our week in review, I don't believe I did an overview of that previous week's which shows we covered. So I'm going to do a couple weeks here just to quickly go over which companies we've been talking about for the last couple of weeks. As many of you know, we talk a lot about resource stocks and commodities, and one of the main reasons is we think that that has been a exceptional place to find above average returns for the last decade. And some of the issues we're going to go into later, we have strong beliefs that it'll be the place to look for exceptional growth in the next decade. In the last 2 weeks, on December 7th, we had a show that we talked about Exeter Resource Corp and Peregrine Diamonds. So there you got one with gold and copper, and the other one is involved with diamonds. You can find the link to that below me on the video player, or you go to our YouTube channel, look for the December 7th show. On December 8th, we talked about Magma Metals, Gold Canyon, and Lakeshore Gold. So we've got a good mix there of platinum, palladium, and gold. Then you look for the December 9th show. In that one, we talked about Nevada Copper and Rubicon Minerals. One's a copper company with a really high quality project down in Nevada. The other one's a gold company with a really exceptional project out in Red Lake, Ontario. Then we did our week in review show on December 10th. And then earlier this week, we had a couple of in the news shows. On December 14th, we talked about Hathor Exploration and Frontier Gold. One's a uranium company, the other is a gold company. Again, all of those links you can find them below me on the website below the video player, or you can again go to our YouTube channel and look for those dates, and you'll find those shows. And then yesterday we did a show and we talked about Extore Gold Mines, Queenston Mining, and Bear Creek Mining. Two of those companies, the Extore Gold and Queenston Mining, are in gold companies, and Bear Creek Mining is a silver focused company. So that's a little bit of housekeeping there we wanted to do before getting on to today's show. I'm doing it the old-fashioned way. Sometimes I do my my little outline of the topics I'm going to talk about. I do it on a file, and sometimes I do it the old-fashioned way. I do it with a pen and paper. So we've got it the old-fashioned way today with the pen and paper. Yeah, the earlier this week, or just in the last day or two, the Congress and Senate and now the President has signed the new tax reform bill, or continuing the tax situation since the Bush era, and and another thing that's happened is the Federal Reserve and their QE2 plans. These two things, I think, are unfortunately going to have pretty much locked in $1 trillion plus deficits for many years to come. You've with the lower, unless you go after, we hear a lot about political rhetoric from both sides of the fence, whether you're a conservative or a liberal. We've had in the United States with the GOP and the Democrats, you hear all this political rhetoric about, well, if you lower taxes and you lower spending, then you're going to spur economic growth. And we've been hearing this tune since the days of Reagan, but the reality has been much different. What's happened is, they've lowered the taxes. In the case of Bush, they had the lowest taxes in 60 years. The result was runaway deficits, runaway debt, and at the end of his term, basically an economic collapse like we've never seen before. So this nonsense about, well, if you do simple answers to anything are always difficult. They don't result in what you're hoping for. What we really need is leadership that goes after and tries to, like a chess player. A chess player is always, what they're trying to do is make the best move. Their next move to be the best move. Not what they're, in the case, if you then put it back to politics, where you make the move that will garner you the most votes. Well, that might not win you the chess game in this analogy. The results have, as I said, since Reagan, Bush Sr., Bush Jr., $1 trillion, now we're into $1 trillion deficits. But during those terms, we've seen the country turn from the largest lender to the largest borrower. On the backs of deficits after deficits, we have rapidly grown the debt. And now, the politicians on both sides seem to want to continue this nonsense of, lower taxes are going to spur economic growth. Lowering certain taxes, yes. Across the board, doing anything, it rarely is going to get the result that everybody thinks it will, or many people think it will. Unfortunately, what will probably happen is, we've got $1 trillion deficits for many years to come. And this is a big if they were to start to go after the big ticket items that cause on the spending side, such as healthcare, Social Security, defense, and now and largely and in the future will become consistently more of an issue is the debt, the interest on the debt. Those are your big ticket items that are going to cause, with these recent tax plans, these multiple years of trillion-dollar deficits and a rapidly growing debt. And the reason I have little confidence that the politicians are going to do anything on the spending side is because making cuts in those areas do not result in helping you get elected. It's okay. Well, you look at the hard one is going to be the interest on the debt. That's a looming problem that's not going away anytime soon. One of the key places I think that you could make some serious cuts is in defense, but it doesn't seem like anyone's in a hurry to end the war on terror over in the Middle East and wants to keep throwing money after that. I think you should bring the boys and girls back home. Start to look at, if you want to spend money in defending yourself, defend the the places where, get those boys and girls looking after the homeland, not trying to protect the homeland from afar. It's been all that's caused is a lot more problems than it's gotten rid of. I think you can do a lot more looking after looking at spending your money in a different way. But then you look at Social Security, health care. Well, those don't seem to be changing. So, okay, you're going to lower the taxes, and some people believe that this is going to cause more spending. Well, it hasn't. I don't think it will. We'll see. The net result is I think that we've got a lot of years ahead of us of trillion-dollar deficits and a rapidly growing debt. We're starting to see some, I've been wrong for about a year and a half now, maybe even close to 2 years on the bond market. I've been feeling that that's been in a bubble for a long time, but we're starting to see that maybe that's starting to get some reality in that market as well. Even though the Federal Reserve is going to try and prop up the bond market as much as they can by buying bonds and trying to keep the interest rates down, they can't keep doing that for a long period of time. There's plenty of supply of debt out there, suspect demand. That's why the Federal Reserve has to get in there so much, and that can't last forever. So, then you hear Federal Reserve Chairman Ben Bernanke come on TV and say, we're not printing more money. Well, Mr. Bernanke, whether you print physical dollars or you print digital dollars, you're adding to the supply. And the reality is that you can't keep doing that forever. You can't keep propping up the bond market forever. I think that lately, even though they announced the QE2 recently to try and continue this, and they'll probably have a QE3, QE4, and how many other QEs they have, quantitative easing plans, they're not going to be able to prop that market up for very long. It's starting to show some weakness, and we think that it's oversupplied and under demand, and if you didn't have the Fed in there trying to prop it up, that the prices would be lower. We've been wrong on that issue for about a year and a half now. I think that we've just been early, and going forward, I think there's more problems ahead for the bond prices. I think that you're going to see yields going up, but I don't really think it's going to be because of economic reasons. I think it's going to come down to supply and demand. So having said all that, some of the things I think you want to avoid is the U.S. dollar and U.S. debt. I think that the U.S. dollar is shaping up for a really big a correction. Last year we said at the beginning of the year that we felt that currency traders are best off to stay away from the U.S. dollar and to put them, and they do much better in commodity-based currencies like the Canadian dollar, the Aussie dollar, and other countries that have currencies that are closely tied to commodities, I think we're going to do better. They have done better, and I think that trend is going to continue. I'm also getting more bullish on the euro. You look at practically everybody's out there talking down the euro. Oh, well, they haven't done this, they haven't done that. Yeah, they haven't gone in and done QEX 1, 2, 3, 4, 5, 6, 10. They haven't gone in and tried to be as aggressive in trying to stimulate the economy. I think at the end of the day, when the developed economies start to get performing better, that the Eurozone will probably get better sooner and recover faster. We'll see how that plays out, but nonetheless, I am starting to get feeling that there's just too much negativity about the euro. And I still believe that commodity-based currencies are going to outperform the U.S. dollar. But now I'm looking at 2011, and I'm getting pretty confident that we're going to be making a pretty bullish comments going forward into 2011 regarding the euro. I still believe strongly that investors are going to be much better rewarded in commodities that are priced in the U.S. dollar. I think, that the U.S. dollar, because of these trillion-dollar deficits and rapidly growing debt, that the U.S. dollar is going to have difficulty going forward. The commodities are priced in the U.S. dollar, and so I think that the U.S. Commodities are going to be a very good place for investors to find above-average returns, and I think that resource stocks are also. Now, we sort of follow the smaller and middle-tier resource stocks, but if you're risk adverse and you still want some exposure, I think there's some really attractive large cap resource companies that, or the commodities themselves, that will far outperform many other asset classes. And so I'm on a little bit of a rant today. One of the chaps I talked to on Twitter is Dennis Neal over at Fox News now, and he got me on a bit of a tangent this morning before I was getting ready to do the show, so I'm on a little bit of a rant today, but again, I think that these issues are not going away. I think we've got some real serious problems ahead for the U.S. dollar. I think we've got long-term trillion-dollar deficits, and I think you're best off to be looking at avoiding U.S. dollars and U.S. debt and looking towards commodities and resource stocks as a much safer place to have your money, and a place where you will get much better above-average returns like we've been seeing for the last decade. I think we're going to continue to see that for the next decade, and these recent actions just give me more confidence in that assessment. So we'll close it now, and but before closing, we always have to stress that we aren't making buying or selling recommendations. The show is for information purposes only. Before making any investment decisions, it's important for you to do your own research and speak with your financial advisors. And we're always trying to grow our audience, and any efforts you make to help us with that, letting your friends that follow the markets know about our website, our reports, our shows, is greatly appreciated. We also greatly appreciate you taking the time to watch the shows. We know that everybody's very busy these days, and we strive to produce a show that saves you time and brings you helpful, high-quality information. Our next show will be next week. We'll start with the week with our In the News shows. The best way to follow our shows is to subscribe. We send out emails whenever we're doing a show, and it's a good way to keep up on all the work that we do, whether that's public speaking, television interviews, these shows, our reports. There's no charge to be on our email list, and so subscribing is the best way to follow what we're doing. We hope you can join us for future shows or check out all of our past work on our website at allanberryreports.com. We'll see you soon and have a great day.